What is stealth QE? And what if the entire economy is propped up by it?
Think about Bitcoin as a global liquidity asset, especially versus, say traditional like US tech equities, which is often what it's been highly correlated to. So if you're talking about the fact that China needs to print a bunch of money, I assume that leads to positive tailwinds for Bitcoin. Is that right?
For sure. And China's not alone. It's every major economy needs to print a bunch of money to basically cushion the effects of this attempted divorce, this decline in globalization. But at the end of the day, yeah, they're going to print money. Bitcoin benefits.
The U.S. financial system is so heavily leveraged that it can't withstand substantial economic shock without imploding. Arthur Hayes says every time markets wobble, the Fed or the Treasury step in with some sort of bailout or liquidity injection into the market. And he's right. If you think about it, we saw this during the repo crisis in 2019, the pandemic in 2021, and even in early 2023 during the banking crisis, when 4 major banks failed and the Fed was forced to step in and inject liquidity into the markets through the Bank Term Funding Program, and also through the extended use of the discount window, which is a facility from the Fed where banks can borrow short-term funds that were more favorable, and the collateral valuation rules were temporarily relaxed to ensure easier access to funds for banks to help stabilize the market. Situations like this happen all the time and are common practice historically. So let's break this down. Welcome to TSG Crypto. We cut through the noise and prepare you for the new era of finance. If you are invested in crypto or thinking of investing in crypto, subscribe to the channel so we can help you navigate through your crypto journey. Now let's get into the video.
I want to bring into this discussion the liquidity situation for especially how to think about it through Bitcoin. So obviously right now it feels like the big narrative is trying to understand who's really driving this. Is it Powell on one side, who's sitting on his hands and trying to remain resolute and hawkish, versus Secretary Bessent on the Treasury side of things, who is obviously going to be political because he's part of the Trump administration, and there's a lot of different moving parts there. So I would love to hear, first off, let's dig into the fiscal side of things and what's going on with Treasury Secretary Scott Bessent and some of the signals that we can derive there to understand where's the liquidity backdrop headed, and what levers can be pulled on the fiscal side of things to drive that.
We all were very well trained from 2008 to 2019 that the Fed does QE. It prints money every week to buy bonds. Stock market goes up, right? Just that was the game. We got conditioned. Where's the QE? Stock market goes up. Bitcoin goes up. Everything goes up, right? And so post 2020, after the little bit of inflation that the world experienced and every central bank raised rates, the community was like, okay, well, we know QE equals number go up. So where's the QE? And from 2022 until the current moment, Powell really, they cut a few times, but we haven't seen, and quantitative tightening was reduced a bit, but we haven't seen a 2008 to 2019 style quantitative easing program from the Fed. And that's left a lot of people saying, oh no, the Fed's being really, really tight, therefore I can't buy risk assets. So I'm going to sit on the sidelines and I don't know what you do. Because you're not in Bitcoin, you're not in NASDAQ, you're not in these things. Now, obviously that was the wrong trait because people forgot about the other side of the equation of what can the Treasury do unilaterally without the Fed. And so we've learned, Yellen, bad girl Yellen, or some staffer at the Treasury Department said, oh, there's $2.5 trillion sitting in this reverse repo program that doesn't really circulate within the economy. How do we get that money to come out of the reverse repo and into these bonds that we need to sell because we have a large deficit? I know we're going to increase the amount of Treasury bills, that is a Treasury debt security with less than 1 year maturity. And if the yield is a few basis points higher than the reverse repo, then the money market fund is going to pull the money out of the reverse repo and put it in the Treasury bill. The Treasury bill gets re-levered throughout the system, and therefore liquidity goes up, stock market goes up, right? Now, Powell's over here doing his, I'm a Paul Volcker, impersonation. I'm going to go and keep these monetary conditions tight. I really care about fighting inflation. On the other hand, Yellen just printed $2.5 trillion, but not really printed. It's not technically quantitative easing. And so people get caught up on this, oh, it's not QE, so the market's not going to go up. Yeah, but it still released a $2.5 trillion into the market. So that was a September 2022 until sort of early 2025 situation. And that was a monster rally. And Bitcoin. Bitcoin went up 6x in that period of time. So focusing on what Powell is doing was correct in the last cycle, but now it's a Treasury show. The Treasury runs the show. They dictate policy. So what do we get out of the news secretary Bessent's mouth recently? He sat down with a Bloomberg interviewer. I think it was on the April 11th or 12th, in the heat of the moment, and said, and the interviewer asked him, "Well, Powell's keeping tight monetary policy. What do you guys have any tools at the Treasury to, help market conditions?" And he said, "I've got plenty of tools, specifically Treasury buybacks." And so again, it was increased bills versus bonds under Yellen, stealth quantitative easing. Bessent is going with Treasury buybacks, another form of stealth quantitative easing. Both of these programs require no input from the Fed, no input from Congress. They can implement them as and when they please. And so I believe that was a seminal moment in sort of this risk-off situation. And to me, that this feels like November of 2022, in that there's lots of reasons to hate the market and Bitcoin at that period of time. But if the Treasury is going to print $2.5 trillion, shit's going up. If Scott Bessent is going to do Treasury buybacks till the cows come home, shit's going up. And it has gone up since he made that announcement. They haven't started increasing the pace yet, but they will do, because they can do it without input from the Fed. And so that's kind of where we're at. Eventually the Fed will come around. They've already indicated that quantitative tightening is tapering. They might do some sort of like balanced runoff where mortgage-backed securities, the maturing mortgage-backed securities, that money is in purchasing fresh new treasuries. So there's lots of things that you can do that aren't quantitative easing, because that's a bad word. The plebs know what quantitative easing is. They know that means inflation. Yeah. You can't do that anymore. You got to be more creative. So I think we have to be flexible in our mental models of what quantitative easing means, what money printing means. Look at the second order and third order effects of, okay, well, if they do this, how do the other market participants react? Do they buy more bonds? Do they move money from a sterilized pool on some central bank balance sheet into the general market, which can be releveraged through the banking system? So we have to be a little bit more, I guess, indirect in our thinking of how the quantity of money changes as Treasury officials all across the world sort of take control from the central banks. Because the central banker says, I want to be independent. I care about the value of the fiat currency, blah, 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 right? And that's what they believe. But the Treasury official says, this government's broke. The politicians want to spend the money. I work for the politicians. Therefore, I will make sure the government can fund itself at an affordable level.
Yeah.
Now, here's where Arthur Hayes really drops a truth bomb. He exposes the fact that the Fed is not the only government agency that can provide liquidity, or stealth QE. This function can also be carried out by the Treasury Department. So basically, there's more than one way to skin a cat. And the Treasury has different methods of providing liquidity to the market. For instance, they can manipulate debt issuance, favoring short-term bills and buybacks to inject liquidity into the system without the Fed ever announcing quantitative easing. Let that sink in. And even if Powell is coming out talking tough about rate cuts and seeming hawkish in the public eye, behind the scenes, money is being manipulated and the system is still being flooded with copious amounts of cash. Now, this is a shocking revelation, but it makes you see the system can't run without constant liquidity. And that's wild, but as you take a closer look, you realize it's true. For example, during the debt ceiling standoff, the Treasury was drastically depleted. Once the debt ceiling was lifted, Yellen did not immediately issue long-term debt to refill the TGA. And at the same time, the government never stopped spending money, meaning the money flowed out of the Treasury and into the private sector. In other words, stealth QE. Now let's jump back into the video.
Okay, so there's a couple points there I want to dig into on the available levers. So obviously the one that you mentioned that Yellen pulled, which was shifting issuance towards the bill side and having that be funded by the reverse repo. That's sort of a one-time gig that you can do, because that was happening when it was at $1.5 trillion. We're at $100 billion now. So you can't run that same game again. Now, obviously there's the Treasury buyback scenario that you're talking about, which, to be fair, has something that was actually started under Yellen, but for the most part, it was very small size. And I would love to the way I see buybacks there is that there's two different routes that they can take. They can take the traditional route, which they've been doing, which is keeping the duration even, where they just, basically sell on the runs and then buy back off the runs, which is the most illiquid part of of the bonds, and so the duration doesn't really change. But what I've been thinking a bit about is, okay, well, what if they tried to do some sort of like Operation Twist style thing where they issue bills, but then they buy bonds potentially? Do you see that as potentially being the next step here?
So I think, and this is from me talking to some of my friends who are really in the weeds on, they work at large bond hedge funds. It's what you described, the former. So it's, okay, I'm a relative value hedge fund. I've bought an on the run bond and I've sold a bond futures contract waiting for that basis to converge. Obviously, as time passes, the on the run becomes the off the run while I'm waiting for this basis to converge. But once the bond becomes off the run, then my bank says I need more collateral against that repurchase agreement, which means I can do less and less trading, or I have to reduce my positions. And so if Bessent can free up leverage, free up bank balance sheet to lend more under the current rules, which again, he thinks are too strict, those will change in the future. But under the current rules, if he can free up balance sheet so that these RV hedge funds can increase the amount of bonds they can buy, then they can act as the marginal buyer of debt as he continues to increase issuance of debt going forward. And again, it's because the off-the-run bond is more illiquid and therefore carries a higher capital charge, higher margin requirement. And so by alleviating the system of this supply and possibly even pushing off-the-run bonds into a premium, then these RV hedge funds can facilitate more buying on the margin of the increased issuance of treasury debt.
Interesting. So he doesn't even need to, do the twist style thing. It's just the fact of ramping up swapping the off the runs for the on runs. That's enough to make for this meaningful increase in the marginal buyer debt. Correct.
Correct. And we know that the debt. Well, I believe that in his next quarterly refunding announcement, which should come out on I think May 1st, next week, Bessent will announce that he needs to borrow more than the market thinks, mainly because, as you mentioned in the outset, Elon Musk Doge, I think I read a New York Times article, he said he was going to do $1 trillion. He thinks it's going to be more like 150 billion in terms of cuts. Tax receipts might come in a bit light because of capital gains receipts. Taxes are low because the market's been tanking. And so, and government outlays continue apace because of the structural, Social Security, defense, all these sort of things that you continue to have to spend money on. Plus, you have Trump tax cuts, which, pillar of the Republican platform, looks like they're going to pass them. That's going to increase the deficit as well. So Bessent's going to have to issue more bonds. The market's not going to like it. He needs someone to step up and buy these things. Their RV hedge funds are there. They just need more capacity on the bank balance sheets. This buyback program, if done in sufficient size, gives them the ability to buy more bonds. And because the purchasing of bonds doesn't come from actual savings, it's stimulative. It's, the government is printing money to do stuff, goods and services, which will increase the amount of credit money in the system, which increases the quantity of money, and Bitcoin responds positive to that.
So if you have, Doge going from $1 trillion to 150 billion, negligible at this point, increased deficits, tax cuts. You have Scott Bessent, who was a huge critic of what Yellen was doing, but is looking more likely like he's going to repeat the same things of just, keeping the party going in some form or another. It feels like a lot of this is a huge fade, and that, the party goes on, does it not?
Absolutely. I mean, maybe in 20 or 30 years, there's some, massive change in global architecture. But for whatever reason, the Trump administration couldn't take the pain to pursue this maximalist position in quickly reversing the current account deficit. Probably because people are like, I can't get reelected if I do this, and that's just the math, unfortunately.
Yeah,
if you think that these are good policies.
Yeah, absolutely. I mean, that really gets to the meat of it here, which is, people like you and I that are also fundamentally bullish Bitcoin, not just as a speculative trading vehicle. It's that, you can't taper a Ponzi. The can will always get kicked. And so here we are looking at, here comes the next big can kick.
So what's the takeaway from this video, and how can we profit from this market? The system is maxed out on credit, and it can't take any pain. It needs constant rescue in the form of liquidity injections, and the system is vulnerable. I think as investors, it's important that we pay attention to fiscal and monetary policies. That means there's more to focus on than charts, green candles, and hype. We have to pay attention to everything, every detail. I think this is a very bullish perspective, and it's not just number go up. It's taking the opportunity to profit from systematic flaws by investing in Bitcoin. But what do you think? If the video was helpful, subscribe to the channel. And if you have anything to add to the conversation, comment down below.